Well, folks, a war between the US and Iran might feel far away, but it quickly touches your wallet, your groceries, and even your investments. Oil prices spike, shipping slows, inflation rises. Markets react to fear and uncertainty. And that's why patience, understanding fundamentals, and staying calm matter more than chasing headlines. That's how you come out ahead. What happens when two countries on opposite sides of the world stare each other down and the shockwave reaches your home, your business, your savings, your future? What happens when a conflict between the United States and Iran does not stay on the battlefield but enters your kitchen through food prices, your wallet through fuel costs, your trading screen through red candles, and your life through uncertainty? Because this is not just a war story. This is an economy story. This is a market story. This is your story. And today we are going to understand one thing very clearly. When US-Iran tensions rise, the effects do not remain limited to missiles, statements, and headlines. They travel through oil, shipping, inflation, stocks, currencies, trade, and finally, into the life of the common man. Now listen carefully, because this is where most people get confused. War does not only destroy. War also changes behavior. And in the financial world, behavior is everything. The moment tension rises, investors become nervous, traders become emotional, governments become careful, companies delay decisions, consumers start spending less, and the market, which hates uncertainty more than anything else, starts reacting before the full event even happens. That is why the stock market often moves on fear before reality, because the market does not wait for the bomb to fall. It reacts when the possibility appears. Now let us go step by step. First, the biggest channel, oil. Iran sits in one of the most sensitive regions for global energy. If tension rises in the Middle East, the market immediately worries about supply. Not because every barrel disappears overnight, but because even the fear of disruption is enough to push prices up. And when oil rises, everything rises with it. Transport becomes expensive, manufacturing becomes expensive, shipping becomes expensive, electricity can become expensive, food distribution becomes expensive. Even products that have nothing to do with oil start getting affected because the entire supply chain depends on movement. So when oil goes up, inflation goes up. And when inflation goes up, central banks get nervous. And when central banks get nervous, interest rates may stay higher for longer. And when interest rates stay high, stock market valuations come under pressure. See the chain? War tension in one region, oil fear in the next, inflation pressure after that, rate pressure after that, stock market stress after that. That is how one geopolitical shock spreads across the world. Now let us talk about the stock market itself. In a war environment, some sectors usually fall. Travel can suffer, airlines can suffer, consumer discretionary stocks can suffer. Companies dependent on imports, exports, or energy can feel pressure. Investor confidence weakens. Foreign money can move out of risky assets. Volatility rises. But not every stock falls. Some sectors often benefit. Defense stocks may gain because governments increase military spending. Energy companies may rise if oil prices jump. Gold-related assets may attract interest because investors look for safety. The US dollar can also strengthen because in times of fear, people often move money toward assets they consider more stable. That is why war does not create one single market direction. It creates a split market. Fear in some sectors, opportunity in another. Panic in one corner, rotation in another. And for traders, this is both danger and opportunity. Because the market becomes faster, moves become sharper, news becomes more important than charts, and sentiment becomes stronger than logic for short periods. This is the time when many traders make the biggest mistake. They overtrade. They chase candles. They buy after a huge green move and sell after a huge red move. They forget that in war-driven markets, volatility is not a friend unless you respect it. A smart trader understands one thing. In a geopolitical crisis, capital preservation matters more than ego. Now let us bring the common man into the picture. Because headlines talk about markets, but real life feels it differently. In the United States, if oil prices rise, gasoline becomes expensive. That means driving to work costs more. Delivery costs go up. Airfare may rise. Groceries could become more expensive because transportation costs increase. Families start to notice that the same paycheck doesn't stretch the way it used to. Small businesses feel pressure because their operating costs go up. Even if the war is far away, the price impact is very close. In the United States, the common man feels war through the pump, the supermarket, the rent, the mortgage, and the job market. If inflation stays sticky, the central bank may not cut rates quickly. If rates stay high, borrowing remains costly. If borrowing remains costly, homes, cars, and business expansion all become harder. Now move to China. China is deeply connected to global manufacturing and trade. When global tension rises, shipping becomes risky, energy becomes expensive, and export demand can become weaker. For the common Chinese, this can mean pressure on factories, slower industrial activity, and weaker business confidence. If global buyers become cautious, Chinese exporters may feel the heat. When trade slows, jobs and wages can feel the impact too. Now move to India. India is extremely sensitive to oil prices because it imports a large share of its crude. When oil rises, every Indian feels it in some way. Petrol and diesel prices affect transport. Transport affects food. Food affects inflation. Inflation affects household budgets. The common man does not need to follow geopolitical maps to feel the damage. He feels it when vegetables become more expensive, when commuting costs more, when EMIs feel heavier, and when savings lose purchasing power. For India, war tensions in the Middle East are not just international news. They are inflation news. They are trade news. They are currency news. They are household budget news. Now let us talk about Japan. Japan depends heavily on imported energy. So when oil rises, production costs rise. That can hurt factories, manufacturers, and consumers. A weaker currency can make imports even more expensive. For the common Japanese worker, the pain may show up in imported goods, electricity bills, and pressure on business profits. Japan is highly developed, but even developed economies are not immune to energy shocks. Now let's go to Germany. Germany is an industrial giant, but industry needs energy. It needs stable supply chains. It needs predictable trade routes. If war tension disrupts shipping, raises input costs, or creates uncertainty in Europe, factories feel it quickly. The common German household may not think in terms of geopolitics every day, but they feel it through prices, fuel, industrial jobs, and business confidence. So when we say top economies, we should remember one important truth. Rich countries don't escape war shocks. They just absorb them differently. A richer economy may have stronger institutions, better reserves, and more tools to respond, but the common man still feels inflation, still feels uncertainty, still feels market volatility, and still feels the pressure of higher costs. Now let's go deeper into trade. International trade depends on confidence. It depends on routes. It depends on insurance. It depends on shipping cost. It depends on stable ports and stable waters. When U.S.-Iran tensions rise, one of the first fears is disruption in key shipping routes in the Middle East. And when shipping routes become risky, shipping insurance rises. When insurance rises, freight costs rise. When freight costs rise, import costs rise. When import costs rise, consumers pay more. This is how a conflict in one region can affect a smartphone in another region, clothing in another region, fertilizer in another region, and food in another region. That is the hidden power of global trade. Everything is connected. and when one link shakes, the entire chain feels it. Now let us talk about the World Bank and why it matters here. The World Bank is important because wars and geopolitical shocks don't affect everyone equally. Poor countries and developing countries often suffer more. They have less room to absorb inflation. They have weaker currencies. They have higher import dependence. They may already be dealing with debt, unemployment, or fiscal pressure. When oil rises, these countries often pay more for energy imports. When food rises, they pay more for essential goods. When currencies weaken, debt becomes more painful. When growth slows, government budgets come under pressure. That is why global institutions like the World Bank, along with the IMF, pay close attention to these conflicts. Because the impact is not only military, it is developmental, it is financial.